Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It's Tuesday, May the 23rd, and I'm delighted to be joined by three of our regular commentators here. Victor Yang, Senior Analyst at JLC Network Technology in China. Ali Al-Riyami, Consultant and former Director General of Marketing at the Ministry of Energy and Minerals in Oman. And Maliha Bengali, from MB Commodity Corner, CEO. Thank you so much for joining us, everybody. Victor, let me go to you first. Let's get a little take on all things China. We seem to be getting some consensus from analysts now that we're nearly now at the end of the second quarter or halfway through, and we've settled into a reality of the growth that we're seeing from China and expecting to see even going forward for the remainder of the year. Do you feel that there is a consensus in China itself on this new, I suppose, less growth than was being expected perhaps in December or January when the economy first reopened?
Yes, that's true. And we know when we first opened, analysts were quite optimistic about fast recovery. And we did see quite fast recovery in the first quarter, but not slow at that time. But we are not expecting slower than expected growth in the coming months, particularly in the industry. Take diesel demand, for instance, it kind of indicates the economic growth quite well. And when we look at April data, we didn't see much growth for March. Say it's basically flat or just inch up quite slightly in April. And gasoline demand grew quite fast in April, as well travel grew quite significantly. But diesel demand is quite another story. So we do not expect quite fast growth in the coming months yet.
Okay, and and why is that? Why have we not seen? I know that diesel demand generally across the world is pretty weak, but China, everyone was relying on really seeing sort of revamp their manufacturing of industry. There seems to be a bit of a crisis in confidence by companies, perhaps. Is that down to uncertainty on what the government might be planning on exports, on its economic policy, or is it just that that is actually the pattern of things to come? Could we see a change in the third quarter for any reason, or the fourth quarter of this year?
Yes, and first of all, a lot of Chinese companies depend on export, and international demand is still not back on stream yet. Take diesel exports, for instance. China used to export diesel to at least 40 countries and regions. And in April, it exported diesel to only 14 countries and regions. That was rarely seen. And second, the domestic demand is not fully back online yet. And people are still kind of concerned about possible recessions in the world. So they're kind of wary too. And, the restrictions and COVID-19 is kind of over, but the impact on the industry remains a lot on a lot of the companies, say financially or some other sectors. So it doesn't mean that we can be fully back online when the restrictions are over. It doesn't work that way, yes. And we expect we expect better recovery in the third quarter, yes. But gradually.
Okay, thanks, Victor. Okay, so taking time to put the three, Mali, let me go to you on that point. Exactly, that of course part of the China economy equation is its export story. And that relies a lot on what's happening in the US and Europe, to a less extent, perhaps, in terms of the products that are going to those economies. Give us the latest with you, the picture of the US economy in the light of the debt default discussions going on, nervousness that may still be creating. Is it creating nervousness? And what's the sort of Q3, Q4 trajectory today?
Thank you. So starting this year, the whole market was predicated on a China demand recovery. And we saw the estimates talking about the reopening, and all the analysts focus on jet fuel travel demand. And that's actually come to fruition. But nobody took a time to look at the manufacturing, the industrial demand slowdown. I know we talk about China saving the world, but if the rest of the world, especially EU and US, are showing weakness, and we've spoken about it for the last few months, our indicators have showed continued weakness in US and European economic data. So China is not going to save the world, and that's not been factored into sell-side estimates. Looking at the indicators right now, Victor makes a very good point. China exports a lot to the rest of the world. So the EU is going through a slowdown, which we see, and right now, China will suffer. So the bullish estimates rest upon China stimulating, providing liquidity injections. And that is the same view in the US markets. The whole market is predicated on the hopes of a Fed pivot or a pause or some sort of loosening or stimulus. But if you look at the pure physical demand indicators or economic data, it's not picking up. You've seen housing weakness. We still have issues with the banking crisis. And it's not about banks failing like 2008. The issue is about lending. It's about credit. It's about a liquidity squeeze. We are not seeing consumer spending. Average real income growth is more negative. You have higher, utility costs. The labor market continues to be strong, but we've spoken about how that this is a lagging indicator. So all the indicators show actual economic weakness. And then we take a look at the Fed right now. The Fed cannot cut. The inflation is too high on their metrics. So I think we're playing this game of chicken and egg in terms of when the Fed will blink. We know OPEC has blinked to cut supply, but Fed has not. Going back to the debt ceiling debate right now, you're absolutely right. Everybody thinks the debt is going to be, raised. But either ways, we don't count for a US default. But let's take a step after the debt ceiling. Even if we raise the ceiling, what's that mean for liquidity? We're going to have more treasury issuance, we're going to have more debt, and the US economy cannot grow. So even if we resolve this impasse between the Democratic and Republicans, it does not mean the markets will rally sustainably because there's economic weakness. So I think it's more for trading outlook versus an economic outlook. And we're still quite cautious based on our forward-looking Q3 indicators. And like we said, inflation needs to come down to 2% before we can sustainably talk about any Fed action. And this is not like the 1970s.
Yeah, and of course, that 2% number, people are questioning, some analysts saying, no, we're going to see a pivot. Not yet, but we've kind of almost reached our limit with the rate rises. And that's what's been, of course, spurring equity markets back into action. But as you're saying, on the ground, not so positive. Ali, let's go to you. And Maliha mentioned OPEC has cut twice now already in the last 6 months, and it's meeting in a couple of weeks or in less than a week or two. Given this negative sentiment in China and the US, the two biggest sort of consumers, why is the market not expecting yet another announcement in a week or two that we're going to cut more?
I think, good morning, everybody, first of all, and good afternoon for Victor. The OPEC decisions and OPEC or the last agreement to cut more from some countries of OPEC, I think it's always been proving that that was the right decision and the right move to move ahead. After hearing Maliha and also Victor, the world is on a limbo actually when it comes to economic growth and financial crisis. So where this demand will come from if we are facing this kind of uncertainties? So I think this was the right decision, and although that it was voluntarily from about 6 or 7 countries of OPEC plus, but I think this time when they meet in 4th of June next month, I think this decision will be taken in and it will be discussed thoroughly by the other members. And again, it depends on fundamentals. OPEC, decisions always doesn't just come like that, but it depends on statistics and studies and market intelligence and so on and so on. So I think, at the moment, we have seen enough of cuts from OPEC for the time being. We will, I think, wait and see until 2 months around, the road later on, and the decisions, it can be taken accordingly. But at the moment, I don't think this time that there will be any more cuts. But I'm sure that this decision of 6 or 7 countries voluntarily taking that cuts, it will be discussed internally, and maybe it will be, the decision is to divide this amount of cuts to everybody. through other countries to take their part on this voluntary cut. But I don't see any reasons why they should cut more. Maybe after 1 or 2 months from now, could be, but I think the decision will be statistic.
Of course, I mean, we haven't actually seen the most recent cut announcements take place yet, literally in the market, and those are expected to start showing on the ground, if you like, next month. So we'll see again what impact they have. Victor, just back to you on the Chinese economy. We're seeing the debate again, the sort of tit for tat trade, microchip trade dialogue, if you like, between the US and China again take a turn with the Micron chip infrastructure China banning that access for US company. Japan now is coming in to that equation with its own moves, kind of reverberating in China, and we're seeing a lot of investment being announced. They're going to look at Japan now to make microchip manufacturing instead of China, given that context. Is there any nervousness or worry, do you think, in the leadership that we are going to see a fundamental shift away from China as a manufacturing base? We had Apple open up an India base again earlier this year. Does the government in China care, given that its economy is a little bit under pressure?
Well, the trade conflict between China and the US and sanctions on each other's companies is a major issue for the country's economy at the moment. And we do not expect this to change much yet for the rest of the year. So the government has been well prepared for this issue. And for the industry too, say the microchip industry and related industries, they have been looking for solutions, yes, for not just this year, but for at least a couple of years. And yes, there has been great impact on the industry and other industry too. So this has kind of slowed down the country's economic growth quite significantly. And not just the US, but also some other countries too, as they are pushed to join the US. So this is one of the major issues that is slowing down the country's growth. And there is there's been a lot of talk in the industry, say, about what China can do about these sanctions on its companies and what it could do. But there's not much concern about whether the base would be shifted to India or other countries. Well, there's still a lot of advantages, for China regarding the manufacturing base. So this is not going to happen quite quickly. Say, even the United States wanted to take it back to the United States, but that's not realistic. It has been away from the manufacturing hub for quite many years, and it is lacking a lot. It's not like China. So there's not such strong concerns about they move away from China. That's not the greatest concern. Yeah.
Okay, thanks. Maliha, let's just talk a little bit about zero in a bit on the dollar itself. Again, in terms of that index, of course, we saw a great appreciation last year, beginning of this year, that stabilized a bit more or less, and people are saying it may have reached its peak, against other currencies, etc. Is that still the outlook now, halfway through the year? And again, what impact, if anything, is it having on thinking in the energy markets in terms of affordability, in terms of emerging market demand, etc.?
Thank you. I think most estimates are probably calling for a lower dollar right now. And the fact that are we expecting a Fed pivot or a pause in interest rates, we've seen the dollar sort of depreciate. But what's happening the last few weeks is very interesting. The dollar index actually is picking up right now. Now, if you take a look at the economic data, we have some regression analysis. We take a look at, European economic data versus a euro dollar, for instance. The economic soft data is actually falling down. The euro is holding up really high at 1.09. The question is, the euro is too expensive. They have a lot of systemic issues as well. So we think the euro is too expensive. We think the dollar is actually quite cheap on a short-term tactical basis, because even though the Fed is going to eventually cut or pivot, there's a whole sort of recession risk. In a recession, in an environment where there's a demand slowdown, slowdown and there's a risk bearish trade, the dollar always rallies. So short term, the dollar is showing its sort of head right now and rating higher. We've seen the Chinese yuan devalue, and most people are completely ignoring the risk because commodity prices are falling. This is quite a devaluation trade going back to 2015, 2016, when the yuan sort of falls this way. Copper, aluminum, nickel, iron ore, they all are falling. We know why oil is not falling, because OPEC is trying to balance the markets sort of very sort of cleverly. But end of the day, the dollar is rallying and nobody has that price in, because we know about the eventual dollar demise, but not the eventual. We don't think the dollar devaluation trade is going to be in the short term. This is a long-term trade about de-dollarization, but long-term, short term, the dollar is still a very good asset to own. And I think that is going to look strong as we head into a recession.
Okay, Ali, just back to you on the Gulf here. OPEC is cutting output again from next month, practically on the ground. But again, it's been right in predicting the trend so far. Is there any concern creeping in amongst? We have a couple of bulletin headlines today, which shows that India's top refiners are sort of reassuring its Gulf suppliers that they're committed to take continuing crude oil. The EU is cracking down on imports of Indian fuels made with Russian oil. Is there any sort of there seems to be a move to reassure Gulf producers that their oil will still be taken by traditional buyers? Any doubt there on the part of producers here in the region?
No, I don't see any issues. I don't see any problems or future problems on that. I think India is always going to be one of the most important market for some producers from the region here, especially the Saudis and also the Emiratis. But the focus always will be from the Far East, China, Korea, and other countries in the Far East. But again, I mean, don't forget that majority of crude, especially from Aramco, let's say as an example, that it goes directly to their systems, even in India and also in China and so on. Although that it is not very much a big volume of that, but the other systems that also using this kind of crudes, they are already committed themselves with the GCC countries. The only country basically may be affected is Oman, because our crude is freely traded. So if there is no demand, then there will be an impact. But because of our crude is one of the baselines of many refineries, especially in China, the teapot refineries as an example. So we don't see any issues and we don't see any problems. So always the crude will see a room or a country or a destination, either in Asia or Europe. Take UAE as an example. Today there was a statement, I think, or yesterday, that some of the UAE crude will go to Europe, and this is a new destination. Let's put it this way, for a GCC country, which normally their crude goes to Asia. But again, the crude from UAE, I think it will be coming from the shareholders like Total and other people, other companies that they have a share of their equities in UAE. But nevertheless, this shows you that the movement of crude now, it is not like used to be 2 or 3 years ago. Everything is changing. The world is changing. And we are all waiting to see the improvement of the economy and open up the full open in China to see the growth. But at the moment, I think the fears on recession, fears on China's oil demand is not there. So we will be in this kind of uncertainties of price going up a little bit, here and there. But this will continue, unfortunately. And I don't see any improvement actually through all this year. I mean, through the year, there are some studies talking about second year of this year. We are just only 2 weeks away from second year, and we don't see any improvement. And others, they're talking about the last 2 months or the last quarter of this year. I mean, these are all numbers, all statistics,
pushing
but
it down the road, exactly.
Exactly. But the average will always be between 75 and 80 barrels, price, sorry,
For the year.
For the year, yeah.
That's what one of our questions earlier this week seemed to, that's kind of where we've been so far this year. And the people seem to think we're going to stay in that average, certainly not be hitting those $90 or $100 again. Victor, that's what people are saying. Anyway, that's never say never. Victor, on that front, in terms of product exports from China, again, the quotas there that were loosened quite a bit in the fourth quarter of last year into the first quarter you were importing, and the economy was sort of getting a bit of a boost. Then, any outlook there going forward for the refineries in terms of what they may expect their quota allocations to be in the third or fourth quarter of this year for export?
Well, China issued the second quarter in May, earlier this month. And so refiners still had plenty of quotas to use at the moment. And this is not an issue, at least for the moment. And for now, the most important issue is the margins. Margins have been negative for over a month now. So this has dampened their interest in exports too. Say for diesel exports, it dropped to quite a low level in April. And Chinese refiners are now looking for more outlets for their products because they had such a large capacity, and particularly, well, over the past few years, increasing capacity. Say 2 more refiners came online between late last year and early this year. And when capacity grows fast, the domestic demand is not growing that fast. So they're trying to improve their product mix and find up better, more outlets for their products. And now exports is a way to address this domestic demand and their production. But such poor margins, well, when margins are so bad, they are not so interested in exports too. And domestic demand and international demand is not strong either. So this is going to be an issue in the coming months too, unless the margins improve quite significantly in the coming months. Yes.
Okay, but of course you're still having an advantage of taking quite cheap Russian crude, which should be a slight advantage there for refining margins. And just to stick with you, Victor, on inventories of crude, I mean, China has quite a good buildup, and at one point they were saying there's no more storage left, essentially, although it has a huge initial capacity. Where are inventories right now of crude in China as we're ending the second quarter? Do we have enough capacity to take more in if we want to?
Well, the stock is quite high now. I would say quite close to the full capacity. And we had a little more capacity, but not like in the past 2 years. So it's not going to take much more. But actually, in the first 4 months, the country's crude imports already recovered by 4.6%. That's not a small rise, I would say. And some feedstock imports in the name of diluted bitumen might have been crude. So the country's crude imports could have been larger than indicated by the official data. So it has actually recovered quite fast in the first 4 months. Yes.
Okay, so probably less expectation going forward.
Yeah.
There's our question for today, which we've kind of talked a little bit about earlier, but I'll go to Maliha to see how she'd answer. Commodity markets commodity meaning energy and other commodities, have priced in that the US debt ceiling debate and the banking crisis that we saw last month, a little mini one, is over. I.e., we've priced that in. It's not going to get any worse. Agree or disagree? Have we seen that priced into energy prices and commodity prices? Maliha, would you agree with that? That we've that's priced in? There may be other problems to come, or not?
I actually disagree, not because it's not been priced in. I think it's because the repercussions of that have not been priced in. The market has priced in a very little tail risk of the US actually defaulting. We don't price that in, but that is a tail risk. Or like we said, once the debt ceiling is even passed, there are a lot of issues in terms of treasury issuance, cash, liquidity, net money supply is going to be falling, which is really bad for risk assets. And in terms of the banking crisis, we know that all these banks have been responsible for a lot of the CRE lending, venture, tech capital investment. So all the risky ventures are being being held back. So the economy is coming to a standstill because the risky parts of the economy are not growing. So there's second derivative effects that I don't think have been priced in by the market as yet.
Okay, but you're still seeing, the equity markets. I know you can treat that as a separate thing to fundamentals on the ground and jobs and etc. But it's the end of May now, and that first quarter rally, which was being sort of said, okay, that's it, that's going to be it. We're still kind of seeing some strength in there. I mean, is that just, again, liquidity still floating around, needing to be placed, or are we going to continue to see that remain strong while we see things differently on the ground?
I think it's important not to look at the top 11 index. More than 80% of the S&P returns are coming from 5 or 7 stocks. If you actually break the stocks down, ignore the Apple, the Amazons, and Nvidia, the market is rushing towards technology, generative AI stocks. All the other 400 plus components are down quite a lot. So I think it's a tale of two soft halves, effectively, right? I think it's very misleading to look at just the top level indices, but markets are broader level down a lot weaker than people expect them to be. This is a pure rush into the lagging technology play. Generative AI is supposed to be the new .com strategy, and people are rushing to the stocks. And that's why the S&P is holding up and giving the illusion of strength. But banking stocks, energy stocks, commodity stocks have all gone hit really hard. So there's genuine weakness in other sectors.
Okay, and there we see our results, agreeing with Maliha, 79%, maybe priced in slightly, but there's more to come, more fallout, unfortunately, nearly 80%. Ali, let's go back to you, talk a bit more about supply. And Iran is one, obviously, OPEC member who is still producing, has had an improvement in its figures in terms of production figures. How much is that being translated into where we're seeing those extra exports going, if at all, by 100,000 barrels a day by certain estimates? And again, on the talks with Iran, nuclear talks, regional powers wanting to advance those or not, do you see that coming back to the timetable, if you like, agenda of the nations that are involved this year?
Two things here. I mean, of course, Iran is exempted by OPEC, so there is no any kind of ceiling for their production. That's one. The second thing, which is more important, and we tend to forget, that the sanction is not from the GCC countries or from producing countries. It's from the Americas and EU. So any kind of agreement that that Iran will have with Saudi Arabia and its region here, unless it has been driven by a decision from America and also EU in terms of sanctions, then the situation will be the same, at least for the time being, until Iran gets in again in the discussion and negotiations for 5+1 for the nuclear deal. That the sanctions will always be there. So that is the situation at the moment. So, but everybody is talking about the momentum at the moment in the region, and that we are getting into a discussion, a diplomatic relationship with Iran. It's all good, and I think this is a foundation of something more to come in the coming few months. But the sanctions are from the Americans and also from the EU. So is that going to affect the agreement that Iran has with Saudi Arabia and other neighbors in the region? Maybe yes, but we don't see that in the future. We don't see that in the very near future. So let's hope that this is just the beginning of a new chapter between Iran and other countries, especially the Americans and then the EU when it comes to their agreement, the nuclear agreement. Inshallah khair.
Inshallah, inshallah. Maliha, we'll let you have the last word. And just to ask you about Russia and sanctions on Russia. We're talking about sanctions on Iran. Of course, we have sanctions on Russia. We have price caps. We have talk of, should we adjust these price caps? And, continuously now being dismissed as having really no real impact except change of flow. So is that still sort of the point of view, if you like, going forward? Continuing Russia-Ukraine war, price cap, whether adjusted or not, we're going to see the same kind of flows coming out of Russia? Or could we see some impact on production at home in Russia, if you like, as these sanctions accumulate?
We get to see the impact of Russian, they have announced cutbacks a few months ago, but we haven't seen their production fall at all. In fact, the rest of the OPEC members, maybe Saudi and some of them, have cut back or cutting back more to compensate for that. So the whole world was very bearish in oil, talking about Russia losing about 1.5 to 2 million barrels per day of supply. We have not seen any evidence of that. In fact, looking at all the data right now, we're seeing more exports as opposed to less exports. And there's some point in contention as to how OPEC will react to that. We'll see that in the June meeting. But no, even today, Goldman put a note out saying, we are wrong. The Russian supply actually is a lot higher, demand's a lot weaker, but guess what? Oil price is already 80% too low. So analysts are slowly coming around to the fact that demand actually is the factor that's taking it down, which we have said for the last 8 to 9 months, and supply actually has been strong. And if it wasn't for OPEC to cut right now, prices of oil would be a lot lower, because the way economic cycles work is that they're boom and bust. But the fact that they're cutting to keep prices at 75 or 80 can actually work to their detriment, because the whole world is going through a recession, and natural economic cycles work better when prices fall to an equilibrium. Demand can then come back on. So I think OPEC is focused too much on price right now, whereas all the other commodities are actually calling and falling in right like price or equilibrium price of demand and supply.
Okay, well, thank you so much, Maliha, and thank you to Victor Yang and Ali Riyami today for joining us on the Daily Energy Markets podcast. Thanks so much, everyone, and have a good remainder of the week.
Thank you very much.
You too. Thank you.
Thank you.
Thank you.
Thank you.